Hi guys, good afternoon. You've tuned into Moneycontrol. I'm Karunya Rao, and joining me in today's conversation is Ravi Krishnan. Typically at 1 p.m. we talk about commodities, but today all eyes are on what's happening in the money market, and the big headline is that the Indian rupee has fallen to a fresh record low. It's for the first time ever that the Indian rupee has hit a 78 level against the US dollar. Ravi, tell us what exactly is spoking the sentiment. Markets clearly are reacting to that as well. The inflation data from US CPI expected today. So talk to us about what's happening in the overall macro ecosystem.
Hello, everyone. Well, it is not really surprising, is it, that the rupee is depreciating? In fact, I would expect that it will continue to depreciate further. See, the Reserve Bank of India does not target any particular level of the rupee. It will just step in to smoothen the fall, to ensure that there are no sharp moves. What are the reasons for the fall at this particular point in time? Well, the latest trigger, I would say, would be the US consumer price inflation, which came at a fresh 40-year high of 8.6%. The consensus estimate was 8.3%. So because of this, what's happening is that the markets are pricing steeper rate hikes from the Fed and also the terminal rate, the rate at which the Fed's policy rate will end up. Once the cycle finishes, that is also edging higher. So, for example, there is a CME Fed Watch tool which looks at the probability of the Fed hikes. So there is almost a 35% probability that the Fed terminal rate could be 325 to 350 bips compared to 75 to 1 percentage point now. So a week ago, this was only around 19%. Now it has sharply jumped up to a 35% probability. So because of this, we have seen that overnight Friday, the U.S. equity markets also fell sharply. The U.S. Treasury yield, the 10-year Treasury yield is now close to 3.2%, and overall, this has made the dollar stronger. The dollar is at a 20-year high now. So these are the reasons which are putting in pressure on the rupee. Also, remember that commodity prices are very high. Oil prices, Brent crude is very close to $120 a barrel, and economists are expecting that India's current account deficit could widen to maybe 3.5% of GDP for the current financial year. All these factors, will end up putting pressure on the rupee further, and we can expect no relief from them soon.
Hmm. But the big question right now is how aggressively could Fed now be tightening its policy? Because that's something that is spooking the sentiment, not just globally, but back home as well. Central banks across the world, especially somebody like a Fed, going more aggressive than anticipated.
No, yes, I mean, so this inflation print, what has it done? So after the April inflation numbers came in the US, there were talks that, maybe inflation has actually peaked, but the May, numbers has actually diminished those hopes. So we can't really talk about peak inflation now. As I said, oil prices are still high. What was the reason for this increase in May inflation to 8.6%? A large portion of it was contributed by energy costs. I think energy inflation, month on month inflation was 3.9%, if I'm not wrong. This is not the annualized number. So this has basically meant that people are anticipating that the Fed will really hike rates aggressively. In fact, it is bringing back fears of what happened during the Volcker era in the 1970s, when Paul Volcker raised the Fed rates aggressively to almost 20%. Recently, as MC Pro, readers might be aware, we have just done released a story today. There was this paper by, Lawrence Summers, which has basically said that the disinflation required to bring US inflation back to the 2% target is quite similar to what it was 40 years ago during the Volcker era. So, we are in for quite a bit of pain because of that, and the Fed that is why even a 75 basis point rate hike is not off the table in September. After the April number, people thought maybe the Fed will raise hikes by 50 basis points in June, and there might be a pause in September, but that is clearly off the table.
Okay. All right. Well, we have to see how that pans out and what will be the commentary from the Fed as well. But let's talk about some data that we are awaiting back home, the consumer price index, which, according to our poll, could fall to 7.1%. Now, is it the favorable base effect at play, or are there more triggers?
Well, it is mostly due to the favorable base effect. There are no other triggers immediately. I mean, look, oil prices are still close to $120 a barrel. That is expected to continue for some time. Yes, sorry. Apart from the favorable base effect, we could see some effect from the excise, cuts and the VAT cuts which happened on fuel. So we might see some benefit from that. But that said, remember that RBI's own projection was 7.5% consumer price inflation for the June quarter and 7.4% for the September quarter. So, once this base effect goes, we really have to see, whether anything else will bring inflation down. I really don't see anything.
Okay. All right. So overall, what will be the key numbers or the key factors that we should be watching out for when the CPI numbers come? How should uh, readers, viewers, investors digest and sort of interpret it?
So basically, we should be looking at food inflation because, food inflation is very important because it is 50% of India's consumer price markets. And I think in the recent policy meet, the RBI governor also said how tomatoes contributed to a good chunk of food inflation. The April number was 8.4%, so we need to see whether there is any softening on that account. And core inflation, of course, it has been more or less stable, but we also need to see, because firms do have pricing power, so we need to see, whether that also kind of goes out of control. Yeah, I think even the headline number will give us a fair indication of where we are headed and what they are paying.
Ravi, how often do you see that the market is falling? So is the currency. Bond yields are soaring. What should investors do in a market like this? Because definitely there is a lot of worry, a lot of uncertainty still that sort of surrounds all of us.
Oh, yeah, but this is again not totally unexpected, right? Because they are all interlinked. Because the US dollar is strengthening and the Fed is aggressively expected to hike rates, we are seeing a lot of foreign investors pulling out money from Indian equities. I think in 2022, around 1.8 lakh crore has been pulled out of equities and close to 15,000 crore in debt, I think. When that happens, that puts pressure on the rupee, and when there is pressure on the rupee and the rupee has a depreciating bias, investors are all the more reluctant to invest in India because it kind of cancels out the gains they can make. And bond yields are up because, obviously, we have seen that government finances are under pressure because after these fuel, excise cuts, and they still have to continue with the food security program and so on. So there is a specter of increased government borrowing from the markets. And not only that, with India's own inflation not really under control, and foreign central banks, because it is just not the US Fed. Now, even the European Central Bank will increasingly get aggressive about inflation there. I mean, gas prices in Europe, they are galloping ahead. And, ECB will also now start taking steps. In that context, RBI can't decide monetary policy in isolation. So we'll see rate hikes increasing here also, which will all start telling on the bond yields. I think bond yields are up 8 bips today. 7 point close to 7.6%. So the yields will continue to kind of inch up. I think.
All right, Ravi, thank you so much for joining us and giving us a detailed macro check. ahead of the important CPI numbers as well. Today, definitely the market momentum is looking quite weak. Let's see how the macro numbers, the inflation data is digested overnight. But that's all we have. Thank you guys for tuning in.
Thank you.